Hi, this is Joseph. Today, I'd like to talk to you about the primary market phases that I use to identify the best trade locations. Additionally, this trading system can be used to trade any market, from stocks, crypto, commodities, indices. So, when we begin to look at the activity on a chart, we start off by thinking in terms of the composite operator, who is causing price to move. All too often, traders will never learn these concepts and they wonder why price is moving the way it does. Not knowing this causes most of the problems for traders. Learning how and why price moves and how to trade it will make you a much better trader. So before we move on, let's talk about the composite operator. Now, the composite operator is a character that Wyckofians use to imagine that there is one individual who's executing a campaign. And this is who we refer to as the composite operator. Very large money interests. You may have heard it referred to in some cases as banks or institutions, hedge funds. These are the best traders operating in the financial markets. And this is who you're up against. Now, what you're looking at is this constant cycle of accumulation, reaccumulation in a markup, and then distribution, and then redistribution in a markdown. And this cycle repeats over and over and over again. But we're going to dig in deeper, and I'm going to show you precisely where we get into trades and how we can trade alongside the smart money. Again, we could also refer to them as the composite operator. Now, what's taking place in this screenshot is that there is accumulation that precedes the markup phase. Accumulation is taking place because of this fictitious character, again, the composite operator. They accumulate shares of stock, and they do it in such a way, and they have to do this carefully, so that they can acquire shares and they don't drive price up while they're accumulating. And they need to accumulate as many shares as they need to before the markup. And we can also think of what's happening here in another way, which is cause and effect. You've probably heard that term before, cause and effect. So accumulation is the cause and the markup is the effect. So let's take a closer look at the accumulation. Looking at the price action prior to the selling climax, that's the SC that you see down there. The stock is in weak hands on the way down. When you see this, you know that the composite operator is no longer participating in the market when it's on its way down. It's important that you know who's playing at the time that you're looking at the charts. This move to the downside is going to continue until there becomes a point in time where the composite operator is willing to step in and acquire these shares. And this takes place at the selling climax. That again is the SC. This is also known as stopping action. Now, typically, the move down is like a cascading effect, and price starts accelerating. You'll also notice that the bars are getting bigger, the ranges are covering greater distance, and volume starts to expand. Typically, very high volume and very large range bars is a sign of climactic action. Now, the way that we know the selling climax is over is because we get an automatic reaction or an automatic rally right here at the AR. And automatic rallies are usually big rallies. These are very quick and they can be 20, 30%. It's all done in a very short period of time. And it's very dramatic and a very sharp reaction. These are some of the clues. These are some of the signatures that we're looking at on the chart to confirm exactly what's taking place. The first thing we do is put up our support and resistance lines as soon as we have a confirmed selling climax there at the SC and the automatic rally or automatic reaction here at the AR. Another thing that will help us identify that we're getting to the end of a move down is the preliminary support levels. This is where you see the PS right here. It's like a little pause along the way down, and it's a good clue that the end is near. We continue to watch when we see the preliminary support levels and then confirm the selling climax. And again, the way we confirm the selling climax is to wait for the automatic reaction. Again, once we have the automatic reaction and the selling climax in place, we put a support and a resistance line there and we leave it there. Because at some point in the future, these two levels are going to have an impact on price. And this is going to give us our confirmation. Now, you don't want to move these support and resistance lines. You can add additional ones to incorporate the overall highs and the lows, but I always recommend leaving your support and resistance lines there at the selling climax and the automatic reaction, because it will help you as you're identifying the phases of consolidation and looking for a choice entry. The market will remember these levels, and you'll also notice that price revisits these levels at some point in time in the future. As you can see here on the breakout, including these tests and these springs here at the lows. From this point on, you'll see that most of the price action is contained within this area between the selling climax and the automatic reaction. Now we start watching volume, and volume indicates that something is going on, and this starts to show that the stock is being acquired by strong hands. However, this is not the point where we get into the stock. This activity is telling us to sit up and pay attention. Pay very close attention, because there is going to be a point in time where we will get into this trade and own this stock. So now we have this trading range in place, and we can see price moving up and down and a constant push of price back down to the lows. This pushing down of price is how the composite operator acquires shares. They do it at the lows. So here's a perfect example of this. And this chart is Apple back in 2009. Notice the big move down, the downtrend there into the selling climax. Again, you can see it there with the SC. And notice the size of volume as this is happening. And also notice the ranges of these bars. And it's important to understand that the only thing that can get into the market with this kind of volume when it's stopping like this is the large institutions. Again, we refer to them as the composite operator. So when you see volume like this, you know who's there. These are the clues we look for in all markets and on all time frames. Now, after the big climax, the big selling climax there, we have an automatic rally or an automatic reaction. You can clearly see it there with the AR level, and that sets the range. Now notice that most of the price action occurs at the bottom half of the range. Now, as a general rule, again, the composite operator will acquire more at the lows. Next, notice how price moves through the lows, but it can't stay down there, and it moves right back up into the range again, and this is very useful information and confirmation that what we're seeing is the composite operator in action. Again, I've highlighted this along with volume. You can also see early on in the downtrend, the selling climax, that the bars are relatively large and there's a lot of volatility there. Sometimes we see gaps on these bars. Price looks like it's going up, and then all of a sudden it'll turn around and go back down and test the lows again. Then you'll also notice as we get further into this consolidation or accumulation phase, the price movement gets dull and quiet, as if it was just like range bound, and the volatility reduces dramatically. And you'll also notice that volume levels reduce quite a bit. Again, these are the clues that we're looking for. Now, this is a very important concept that a lot of traders miss. A big concept in Wyckoff is supply and demand. Notice when we look all the way over here to the right, you'll see volume is just really low compared to the initial reaction at the selling climax and the automatic reaction. At this point, the shares are in strong hands, and the shares aren't available anymore after they accumulate the stock. The only thing that can happen when stock is in strong hands, it's got to go up. There is a misconception that you need volume to drive prices up. Well, that's not necessarily true. And I've said this many times. If you don't know how to use volume or read volume on a chart, it can be a little bit deceiving. And here's a perfect example of that. So again, it's not necessarily true that you need more volume in order for price to go up, because it's supply and demand. When there is no supply of stock, how much demand does it really take to drive prices up? Any amount. It takes hardly anything for price to start moving up once there isn't that much supply. And you'll hear me often say we're looking for the footprint of the smart money or the composite operator in the chart. The smart money or the composite operator will always try to buy in an accumulation area on a move down. Again, pay attention to the price, the range, and the volume as price starts to test the lows again. Now, when price starts to move up and out, the composite operator will begin reducing their activities. And as price starts to move up, they'll wait as price starts to fall again if they have to, and it's required that they buy again. Now let's take a look at the setup and what to do with all of this information. Our trading system is all about taking action. What do we do and when do we do it? That's the question. There are rules that confirm a trade, and these are the steps necessary to take a position. If you remember in that Apple chart, there was a lot of activity inside of the middle of that range, very choppy conditions, a lot of false signals, but we aren't going to act on that information and that activity, but we'll use it. So ultimately, our advantage is that once the composite operator is done, we've tracked and confirmed the behavior, but our preferred trade location is in the phase C and D. I'm going to show you that in just a moment. Phase C is the last testing of the lows and then that last test. And these are the springs. And these springs are a favorite trade of ours. And then we see the last point of support. And then a jump, which is something we discussed in the Apple chart. how we notice the large range bars closing near the top of the range to the upside. And this also helps to confirm this action. In phase C and D, this is where we go to work. This is where we enter. We watch the composite operator like a hawk, and then we wait for the spring or the confirmation of the lows, and then we get in. So let me show you a better example of that. Now let's take a look at Netflix. This is a real campaign deployed by a real composite operator. It was initiated by a hedge fund. The first thing we look for is the big range bar with volume on the gap into support. And then we look for and confirm the automatic reaction. And then we draw out our resistance lines and our support lines. Remember, we want to draw them in immediately when we get confirmation that we have an automatic reaction. And we want to draw them out immediately when we get confirmation that we have a selling climax. And then leave them in place. From this point on, for quite some time, price spends most of the time at the lows of accumulation in this chart. This is exactly how it works in the real world, and we can see it here in the charts. And then we have the spring, and then the test. And the spring is basically a push down through the local significant support low. Now, looking for entries, we don't necessarily get in on the spring. We watch, and if the spring has volume, then most likely the composite operator is watching price as it breaks the lows. They're watching this to see if more supply comes out. And if more supply comes out and it keeps going, then they determine whether to accumulate more as weakness continues into the lows. But typically, as in this case, it stops and then turns back up, and then you see the move up and then the test. And the test is the first place we can put a trade on. There are several locations where we can place a trade. From this point on, price typically moves pretty easy to the upside. Big bars, more volume. Then we make another test, again right here, last point of support, which is another location that we can place a trade. And then we get another last point of support. From this point on, it typically moves up pretty easy. Big bars, more range. And then we make another test, which is considered the last point of support again. And then a final breakout of the consolidation. And then another test right here, which is another opportunity to enter the trade or to add more to the position. This is a perfect example of the markup phase. So to review where we can get in, we buy on a test of the spring and the test and the last point of support. Or when price is finally broken out of the range and then backed up to test again, we can buy again on the last point of support. And we usually don't get into the trade in phase B. We're looking for the big moves and the markup. And this works for day trading, swing trading, investing, trading any market from stocks, indices, crypto, forex, commodities. Using a system like this means that you'll always know exactly when to get into a trade and when you should stay out. There's no more guessing. This is another favorite trade setup. This is a up thrust after distribution. So now we're going to talk about distribution. What we were looking at before was the area of accumulation at the lows and then the markup phase. Now we're looking at an area of consolidation at the highs and then the markdown. So one of our favorite setups is the up thrust. So you can see here there's an up thrust after distribution has set in. That's the UTAD. In this distribution, there are some differences in how this develops, but the structure is basically the same. My coaching students and I like to say that you can make a really good living if you just trade springs and up thrusts. So it's a really important strategy to learn. One key difference between accumulation and distribution is that volume dries up in accumulation on the way down, and it's the exact opposite in distribution. In this chart, you can see the big volume spikes. This happens because the volatility becomes greater and greater as you go through this distribution phase. And this typically happens because the composite operator is getting out, and they are no longer interested in this stock, and they want out before the markdown phase. Volume will increase as it goes through its distribution, and you can see that on the chart here, marked by several circles there. And the places we want to enter is basically the reverse of accumulation. And when we see price testing the highs on these downswings, there are big bars moving down and then little consolidation ranges as it pauses